Okay, well, welcome everyone to the Global Market Outlook for February 2023. Should you buy the January rally was the impossible question that our marketing team has posed to me today. I think why are you joining to hear what our thoughts are around the fantastic January that we've had so far. It's going to have to be quite a quick session today, so I'm going to have to keep it just under an hour. There's a lot to go through, so to try and answer that question, I'm going to go through equity markets, economic indicators, commodities, currencies, and I'm going to have a quick look at our portfolio as well and how we're positioning ourselves. Yeah, and try and answer that question. Before we start, who are we? As many of you guys know, we do online trading and private broking. That's really part of our stockbroking offering. We do asset management through our managed portfolios. Structured products, something that Viv takes care of, basically contingent payoff notes, quite useful for investors that are looking for low and medium risk investment options. Offshore transfers kind of ties all our international businesses together. Wealth management, tax-free savings accounts, obviously also very important to getting a holistic picture and being able to offer you guys some tax benefits as well. Okay, so we obviously won a couple of awards as well. So we currently ranked the #1 with securities broker in South Africa. We're also the top self-service broker. We've actually ranked #1 in the Financial Mail survey for 3 out of the last 4 years. I'm very happy with what the guys are doing. Van and Christo, who sit on our desk, have actually rated as individual relationship managers. So if you chat to them or if you're with us and you work with them, you are in the hands of the best, which is always nice to know. So let's turn to equity markets and start trying to work out what's going on and where we are currently. So the first thing is, should we be buying into the January rally? I mean, if you've had a look at your statements, if you've had a look at, I suppose just about any investment at the moment, you'll see that we've had an enormous recovery. Why have we had such a large recovery? There's basically 3 big reasons. So there are 3 big problems and 3 big problems that are starting to look like they have solutions. So the one is that obviously China was closed. So we had all those supply chain disruptions. It was shocking the whole economic system and creating, I mean, they're all going to be linked, but it was essentially creating inflation. It was reducing international demand. Oil prices, for example, came off because we didn't think that that China would be demanding. There was just no economic activity there while people couldn't travel, while there was still those strict zero COVID measures. And China has now opened borders. So since we last met in November last year, I think we met in November or early December. Since then, China has scrapped all its COVID controls, and there's this idea that with China reopening, they're going to start demanding commodities. You're going to see goods, all the cheap Chinese goods making their way back onto international markets, and a lot of those supply chain disruptions, subsiding. That should have an impact on reducing inflation. At the same time, we have seen positive things in the inflation numbers, and everyone is still very, very focused on the Fed. So Powell's speech, this is actually a headline from CNBC today, triggered a frenzy in that even topped the meme stock frenzies of before. So a lot of people are watching these speeches, trying to gauge when will the Fed blink, when will we start getting easier monetary policy. And if we see inflation starting to come down, that's going to be possible. And suddenly we're going to be, and if we do see, the Fed has been saying that they're going to continue hiking interest rates. And certainly leave them high, all the way out to 2025 if you listen to some of the Fed officials. But the market is certainly not believing that. The market is starting to price in cuts coming through towards the end of this year. And that's why you're seeing this huge upsurge in equities, because if we get a looser monetary policy, it means equity markets are a screaming buy. It's almost a no-brainer to buy them, which is where we're seeing this big recovery. At the same time, we are seeing, we can't have the Fed starting to take an easier, more dovish outlook on monetary policy, certainly in the US or anywhere else, if inflation is still in the system. The thing is, inflation is starting to come down, and we're seeing it specifically in the goods market. If you listen to Jerome Powell's speech when he tightened by another 0.25%, very much pointed at the goods market and said the goods market is seeing, has turned the corner, and we're starting to see disinflation. We're starting to see things normalizing, and it's happening first in the goods market, not really in the service market. But that speaks to the fact that some of this is actually transitory. You'll remember that word that everyone mocked and says, no way it's going to be transitory. But as China opens up and goods and services start flowing again, we're seeing prices starting to moderate, and I'll show you some charts of that in a second. And if that's true, and they can cut interest rates, then this is going to be a monstrous equity bull market. So everyone is sort of buying into that over the last, say, 2 months. And what you've had is, if you look at the fear and greed index, which is a gauge of I suppose, it's the volatility index combined with put-call ratios. It's a whole composite index about how, to try and gauge the sentiment of where the market is at the moment. We're in greed. So should you buy the January rally? Do you follow the Warren Buffett philosophy? No, you shouldn't. You shouldn't be buying into this because, you buy when others are fearful. You don't buy when others are greedy. And it does seem like this is quite extended. You can see there's a chart down here of how the fear and greed index moves over time. And you can see it fluctuates. Markets are almost bipolar. They're happy, they're sad, they're happy, they're sad. Everyone is very happy at the moment. That's why you're seeing equity prices moving higher. Is this the time to be piling into the market? Short term, this index is probably saying maybe not. This is just a look. Okay, so we haven't met in a while. So this is a look back over the last 3 months, and you can see where the returns are coming from. Huge recoveries in tech. Tech and China are the two big recovery stories. So this is obviously the US market that you're looking at the moment. You can see Microsoft up 17%. We've had news out. I hope everyone has played with Chat GPT. I mean, we've been talking about GPT-3. We've been talking about stable diffusion and all these things for years. But it seems like AI has entered the zeitgeist. Everyone is, certainly in the investment circles, everyone's starting to talk, oh, it's AI is amazing. It's something that we've had on the radar for 6-7 years. We've been investing for AI for a long time, and we can talk about that in the portfolio. But we're seeing this kind of excitement around that. We had Google down last night, obviously just on the back of their AI day, where they released their Bard, and people were like, wait a minute, this isn't as cool as we thought it was going to be. It's still our view that Google's DeepMind is an incredible AI tool, and what Google has been doing over the last 6 or 7 years is hobbling it to make sure that it isn't dangerous or it doesn't come out with crazy inappropriate things. And what OpenAI, if you go back to the history, OpenAI was actually started one by Elon Musk, and Microsoft has obviously invested heavily in it now, but it's really to try and tackle the dominance that Google had in AI. And now, we were chatting about in our research meeting this morning, we feel that, Google is starting to release things, but you can see Google is going to take the gloves off DeepMind soon. And we do believe that it is still a dominant player in AI, despite the kind of temporary blip that we saw in the share price. Meta up 89%. All we had to do to get Meta to recover was for Mark Zuckerberg not to be absolutely crazy and try and spend a third of the market cap of his company building the metaverse. And since he decided to be a little bit more responsible and look at a bit of cost cutting, what we have now is a stock that is absolutely flying. So huge moves higher there. You can see the red sectors at the moment. So oil and gas and energy, so the sectors that were really bought up in 2022, starting to come back in January, as you see a rotation out of value back into the kind of traditional growth and momentum stocks, with this view that interest rates might be coming down. Now we have to decide if you're going to buy or sell the Janu-rally, whether or not you believe where interest rates are going. We'll talk about that in a second. The other sector that's coming down is the traditional healthcare plans through something like United Health, also coming down at the moment because those are the typical value defensive. Now we own Johnson & Johnson, we own Pfizer, we own United Health in portfolios, but we also own Google and Microsoft and Amazon. So, when we're doing a deployment for clients at the moment, what are we buying? We are buying into the Janu-rally if you want to know what our actual movements are, but we're actually picking up those defensive. Lovely levels on Pfizer, great levels on Johnson & Johnson. and we're starting to move back into the more defensive counters, using this January rally to build equity exposure in safer counters. That's how we are playing it for clients. If you go to the international markets, you can see what's happening in China. You open up China, there's also been, I suppose, a moderation of the rhetoric around Chinese tech companies. There's also been I think a much more market-friendly and business-friendly approach taken by Beijing, and you can see the result there. You've got Alibaba up 50% over the last 3 months. We own Alibaba, and you can see underneath that a lot of the Chinese ADRs, so American Depository Receipts, absolutely flying over there. Taiwan's like basically all over the place, doing very, very well. And yeah, it's been a very, very positive start to the year, which is great news for investors. I think when we last met, I said, guys, this is a fantastic opportunity to buy in. Hopefully everyone was listening. We were looking at essentially taking funds out of the country at that stage. The currency was fairly strong. It generally is strong over December. And hopefully you guys took advantage of that. This is now a chart. Okay, so I've just done the Vanguard tracker, but it's basically the S&P 500 index that you're having a look at the moment. Hi, yeah, sorry, I don't know what happened there. But technical gremlins. Hopefully, you can still see the screen that we are sharing, and hopefully you can still hear me. If you can't, please just hit me in the chat window or the Q&A section and let me know. But yeah, what I was saying is we're looking at this trend line very closely. We've now had a break based on, it really coincided with the 1st of February Fed meeting, breakthrough, starting to move higher, and that is a technical break. So if you're looking at this chart, and I think a lot of short-term traders are looking at this chart, this is incredibly bullish. It signals a total trend change. It's saying that you must definitely, absolutely, buy into this January rally. This isn't going to stop anytime soon. It's a fundamental change. Now, where would we be buying into it? If you look at something like the RSI down at the bottom here, RSI is, it's an oscillator. It doesn't work well on breaks. But even so, the market does look a little bit overbought. If you're listening to the, I suppose an oscillating index like the fear and greed index, it's also saying it's overbought. It's saying probably just be cautious. Look for your deployment. Absolutely, you should be looking to build exposure in equities, but you might get a slightly better level in the short term. So, the optimum, if you're looking at traditional technical analysis, would be wait for, that's a break of a trend. The resistance becomes support. You'd wait for the market to pull back to around, pull back to this level down here, and then you should pile in boots and all, because the trend has changed, and you probably, if things work out, that lower trend line, if you move that up there, you should see like a rising volatile sideways channel. Like that would be the technical prediction, or my technical prediction anyway. But yeah, it's so I think maybe a little bit lower, but absolutely you've got to have your finger on the trigger. And when you're buying into a stock market, the beauty is that you can build diversified exposures. As I said, you've got a lot of counters that have pulled back, the more defensive counters. I think that's the opportunity to start moving into them. Then at least also, if you're wrong and the market does continue to be volatile and sideways, and we have issues around Ukraine or whatever the case is, or maybe China-US tensions start lifting because there's spy balloons and all sorts of things flying around. If that does start happening, you've picked up some good quality defensive counters. It's a nice way to start entering the market when you're still a little bit concerned about the underlying economic picture as well. So really, really like the kind of defensive counters for now. as something that you can pick up exposure to. But yeah, that's a chart that everyone, I think, is looking at. So let's have a look at the economic indicators quickly. What's happening in the US that has prompted this big kind of general global move? So the first thing is inflation is coming down at a rapid pace. And a lot of people are saying that, inflation rose faster than anyone expected, and it's also going to come down faster than anyone expects. So we have next week is going to be absolutely key. So anyone that watches markets closely, next week is what you need to be looking for. We've had the Fed meeting this week, a little bit more quiet. We've obviously got Sona later tonight locally. We've had Biden's State of the Nation address as well. But next week is the important stuff. It's what's happening with inflation. It's not these politicians talking, which is generally doesn't make any difference anyway. This is the real stuff. It's like what is happening in the underlying economy and how our monetary authority is going to be able to react to that. So what's happening? Okay, we've got a forecast. Okay, so the forecasts on in, there's about 5 forecasts from the big banks so far, and they're saying they're expecting another print of about 6.5% in the US. Those expectations will build into the 14th, so it's like a Valentine's Day number, 14th of Feb inflation number. We obviously have the South African CPI number as well, so we've got our local stuff as coming out there. But you can see that the big decrease in inflation that's happening, and that's we had front loading of interest rates. So you've got interest rates, after the last 25 basis points hike, they're up to the Fed funds target rate is between 4.5 and 4.75 is how they work it. And it was aggressively hiked. You can see the steepness of that hike was one of the steepest rate hiking paths ever undertaken in history. And it does seem to have stabilized things, and obviously China opening up and kind of the supply side shocks working through the system are also helping to bring down inflation. And it doesn't seem, now if you look at the unemployment number, it doesn't seem like it's yet affecting the labor market. And it's good news and it's bad news. So on the one hand, you've got the non-farm payroll number that came out, it was last Friday. Absolutely incredibly strong, like really, really strong. We were expecting the unemployment rate to move from 3.5% up to 3.6%. And what happened is it just shocked the market and went the other way, and it went to 3.4%. So it's now the strongest labor market print on a non-farm payrolls number since May 1969. It's a 53-year low. It was a total shock, and that's actually what sent the dollar just absolutely flying, because suddenly the market was thinking, wait a minute, if the labor market is this strong in the US, there's no way we're going into recession. There's no way. It means that the economy is running hot. It means that there's got to be more interest rate hikes than we thought. What happened is the dollar went absolutely berserk. You can see it in our local currency market. We'll look at the currency where we went immediately to kind of 1770. 1770, 1775, I think we touched 1780 yesterday to the dollar. And that was all on that. But the one optimistic note, while 517,000 new jobs are added versus an expectation of 187, I mean, it was a shock. The one optimistic note is that we didn't see a lot of wage price inflation, which means inflation isn't embedding in the US system. It means that, and our reading on it is that workers in the US are actually too afraid to go and ask for job increases. They know that inflation is a problem, but there's this fear that there's going to be a recession. So even though an unemployment rate is so low that the labor in the US has huge bargaining power, they can go and ask for wage increases. They're actually not asking for them because they're kind of buying into the idea that there's going to be a recession. We better protect these jobs. Maybe I mustn't go and ask for that, above, inflation linked or above inflation increase, because I'm actually afraid that I'm going to lose my job. If you look at the big updates, the headline updates out of the big tech companies and the likes of Zoom and CRM, so Salesforce, all cutting jobs, and big headline of 10,000 jobs cut here, 10,000 jobs cut there. And everyone is panicking because they're reading those headlines. But the fact is that the underlying economy is not losing jobs in the US. And where we've seen the job pick up is we saw 128,000 new jobs in the leisure and hospitality sectors. So while you're seeing some of the big techs, the kind of companies that were benefiting from COVID, that were saying, wait a minute, all businesses need to digitize things like Salesforce and Microsoft. I mean, if you didn't have Teams to do Teams calls with people, I mean, what were you going to do? You had to get your upgraded Microsoft package. And they were bringing in employees like you couldn't believe. Zoom, what we're doing this webinar on. I mean, they were ramping up production, like when I say production, but ramping up capacity at a massive, massive rate. they're now going, wait a minute, we took on too much. We've got to get rid of these people. Fortunately, in the US, one of the great reasons why we invest in the US, you can just fire those people. So they've, dropping huge amounts of jobs. That's making headlines, and labor is scared. So they're not asking for high increases, which is actually suppressing inflation as well, which is why inflation is coming down faster than many people expect. So it's actually quite a good picture. The problem is if labor wakes up and starts asking for those wage increases, what's going to happen? Inflation is going to remain quite sticky, and you might not see it coming. Then you're going to see inflation starting to spike again. If that's the case, then we're in a very difficult world. Remember, our base case is that we will see unemployment in the US break 5% this year. That's our kind of prediction. So at the moment, not working to the system yet, but it's a long year ahead. We know from the last couple of years how much can happen in 1 year. So still keeping a close eye on that. Will the Fed stop hiking interest rates at this stage? Probably not. This is the Fed funds futures graph. The next meeting of the US Federal Reserve is on the 22nd of March. 93.7% chance they're going to hike by 25 basis points, 6.3% chance they're going to hike by 50. So there is a chance that they hike by 50, but overwhelmingly we're expecting another rate increase from the Fed, come 22nd of March. SA economy, very different picture. Different, but not massively different. Okay, now we're in a little bit of trouble. We can see we've got our inflation number the day after the US number, so it'll be the 15th next week. I think it's a Wednesday. We're seeing that the annual inflation rate is coming down. So our inflation rate is coming down. Remember, our target band is 3 to 6%. We're still outside the target band, and it is starting to come down. But remember, we had a windfall from those high commodity prices. We were doing really, really good things. Anyone here understands the pressure that South Africans are under with load shedding and energy. We're going to hear about it in the State of the Nation today. We're feeling it in the currency as well. South Africa is not a happy place currently. We've had obviously that open letter to Ramaphosa from essentially consumer goods companies, retailers, and all, saying that basically, do you want medication and food to reach our shops? If you don't sort out load shedding, we're going to start having shortages. We're going to start looking like a real failed state. And nothing, I said this on CNBC this afternoon, I said nothing changes governments as fast as a starving population. If our food security is no longer here, things are going to get very, very hairy in South Africa. So while these numbers, yes, are trending in the right direction, unemployment is trending in the right direction, that was a benefit of our mining sector picking up. Go and read the mining updates. I mean, we've had Sasol coming out, we've had Tungela coming out, we've had Kumba coming out. All of them, the same problems, Transnet. They can mine it, they can produce it, they can't export it because they don't have, the rail infrastructure is failing. It is not a pretty picture in South Africa at the moment. Growth rate, we don't have new growth numbers. Repo rate, obviously still staying high. If the repo rate will, because our problems are very structural, the repo rate will largely mirror what's happening in the overseas economies, unless we decide to be some like Turkey and have high inflation, decide we're going to cut interest rates anyway, just like crazy people. But yeah, so not a pretty picture, but the numbers are still okay, but they're not normalizing fast enough. We had this with the commodity boom that we had this huge opportunity as a country, and I don't think that we seized it right. My view of the South African economy at the moment is, got to get money out. You've got, like, if you don't have an offshore bank account with offshore investments in it, you are a braver person than I am, certainly. And I'm very pro South Africa generally. Commodity markets, I'm going to really rush through commodity markets today. So you can see that commodity prices are still elevated. Pity we don't have the rail infrastructure to really take advantage of it. But yeah, still elevated, but definitely moderating as supply chains have worked through the system. What is the impact on commodity markets of when China really starts to ramp up again? That remains to be seen. We aren't seeing capex at the big mines. I mean, we've seen a couple of deals here and there, but there hasn't been a lot of new shafts sunk. There hasn't been a lot of capex spend on new capacity, and that is a little bit concerning, because that can mean easily another commodity spike. Might actually be quite good for South Africa, but the idea that we're going to see commodity prices fall 30, 40%, Personally, I don't see it this year. I think we're going to still see that commodity tailwind coming through. To build these mines, I mean, the miners got burnt last time around. This is when they can raise, it's the natural commodity cycle. This is when they can raise capital. This is when they can go and, do mega projects that end up as a disaster. You don't get the sense that these mega projects are coming. You get the sense that everyone is still very, very cautious, and they're more focused on cost cutting and the actual operation. Certainly in the South African mines, we've just had the mining in Durban as well. There's infrastructure challenges that they are facing that is preventing them from investing more. And if you don't invest in them, we're going to have what happened with the oil price. There was underinvestment in the oil market, and that's why you saw oil prices running. If we looked at oil markets, you can see oil prices have come down. Part of this is also because a lot of the oil contracts are actually priced in dollars. It was actually more of a resurgent dollar that made it look like oil prices were falling. So it does. I mean, going through the OPEC report, OPEC is still very, very conservative. They haven't really increased quotas or anything like that. So the oil market should still be tight, but it's not looking tight. But for me, it's mainly a dollar story there. And China opening up is obviously going to give a lot of a kind of a jump to that as well. We're seeing, so just interesting notes on this one. So this is the soft commodities. I'm not going to harp on it, but massive spike in orange juice over the last month and a half. So orange juice, concentrated orange juice futures, usually big trading in Miami there. Really spiking. Not actually sure why that is. I need to still go look into that, but yeah, that's on there. I mean, we will share the slides afterwards, so you can go and kind of dig into these commodity charts yourself as well. Power complex, as you can see, I think we've been fairly lucky with the temperatures in Europe. Remember, we were kind of facing like a real energy crisis in Europe. Power prices have been coming down, European power prices at least. So the Ukraine war not having the dramatic event, but there certainly is the potential for escalation there as well, especially with the kind of, it does look like the US is starting to get more aggressive and really start to participate. That could be a huge risk event for markets coming up. Commodity markets, grain and oil seeds, you can see, the kind of spikes that we saw around this time last year. Obviously, everything is coming off a high base, and it is, we have seen a big moderation as well. So it does look like supply chains are sorting themselves out. Now, precious metals, I'm going to spend a little bit of time on this. And last year was a difficult year for everyone. Don't get me wrong. I mean, if you were an equity market investor that were kind of white knuckling through it, it was a difficult year. A lot of people, there was a lot of pressure. Now, as an investor, you shouldn't have felt that. We've engaged with a lot of clients recently, and we think of like the kind of the 3-bucket system. If you've got a 5 to 10 year view on equities, last year was just a buying opportunity. It was an opportunity to move some of your liquid cash into the equity markets. That's what you should be doing. But a lot of people don't behave like that. They look at their equity portfolios on a regular basis, and when they're down 20% or 15 or 30%, I mean, one of our friendly asset managers, I think they ended the year 35% down. Not that we invest with them, but kind of always keep an eye on them. I mean, that's a horrific year. I think they're very exposed to the tech and consumer discretionary space. They didn't have kind of proper diversification. But I mean, massive thing. But where could you have protected your money? We have a lot of partner hedge funds that have done very, very well over the period. We obviously promote structured products. Our structured products did exceptionally well. I mean, everyone ended positive. I mean, we had guys pulling out sort of like, 17, 18% returns in dollars last year out of the structured products. But one thing that I want to have a look at is, like, if you just look at these charts, you would think that, yes, the dollar has been the go-to place. We've got problems in Japan. Obviously, Japan has an enormous debt to GDP. The Bank of Japan is very constrained in its ability to raise interest rates. And what that's causing, I mean, it's one of our big key risk events for the year, but it's also causing the yen not really to be the safe haven asset that it used to be. It used to be dollar, yen, and gold. Now, dollar, not really. Now, gold, if you look at gold, now gold is one of the things I want to look at. If you look at a 3% return over the last year, this is a 1% chart, you would say, oh, gold was terrible. But gold was terrible in dollars. And the dollar was so strong, and we'll look at a dollar index in a bit. So strong. So it's kind of not really telling the story for people that used gold as a hedge through a very, very difficult year. So I thought, let me just recalculate that for you in Rand quickly. So essentially, a year ago, the Rand dollar rate was at 15.20. The gold price was at $18.32 per ounce. So that gives you around 27,846 rand per ounce of gold. The same today, the rand dollar is sitting at 17.65. You've got gold marginally stronger in dollar terms, so 1886, but that's now sitting at 33,287 rand per ounce. So what does that actually represent for if you were just a physical commodity holder or physical gold holder over the last year? You kind of topped up your gold holdings because you thought that it was going to be a difficult year. It actually worked perfectly for you. In rand terms, you finished the year up 19.54%, which is a very, very decent return. Gold as a hedge did work in portfolios last year. And really the reason that you look at the dollar gold price and think, oh, gold really hasn't done too much, it's because the dollar has just done so much. So I thought I'd just include that in the precious metal section. Currency markets. So we've got, okay, so let's have a look at the rand dollar rate. So this is the forecast as of the 7th of February, so 2 days old. And I was surprised when I saw this. I've got to be honest, I was shocked. So Investec has a target price in 1 year, and Investec has been fairly bearish over the last little bit, 13.25. They see a huge recovery in the South African rand over the next year. They are the most optimistic of the banks. We're currently trading, as I said, 1765. The median estimate of the brokers that did participate in the Refinitiv poll is sitting at 1653. So it's significantly stronger than where we are now. So, my sense at the moment is that the currency might have done a little bit too much. We've got a little bit of nerves ahead of Sona. We are underperforming. Okay, one, it is a dollar strength story, and I'm going to show you cable in the euro shortly. But we are underperforming versus, the rand is underperforming versus all majors against other emerging market currencies. So there are definitely there are domestic factors at play here as well. The idea of the levels of load shedding that we have is playing into the local currency. You cannot tell me that this is an offshore story, because it just isn't. Maybe a little bit of nerves ahead of Sona tonight as well, but obviously we saw the currency blow out. It does look a little bit overdone. I probably wouldn't be buying dollars around here. I would instead be looking to bring dollars back to South Africa, repatriating earnings, whatever you're doing, that you're doing the reverse flow. I would be doing that. And you can kind of see where the big banks are. Nedbank at 1671, Standard Chartered at 1650, Bank of America, Merrill Lynch sitting at 1643, Morgan Stanley at 16. So all significantly stronger than from where we are now. Then if we look at the dollar index, I just wanted to show you a picture of this. You can see since kind of October, November last year, that's where we started to see the market rally. We started to see the kind of optimism flowing back into the market. And what happened is we saw money flowing out of safe havens like the dollar. This is the dollar index, which is basically, they look at the US's largest trading partners. It's an index of the 6 of their largest trading partner currencies, things like pound, euro. I think the franc is in there as well. There's a whole lot of things in there. Can't bring all 6 to mind now, but you can see the dollar index has gotten a lot stronger over the period. We have had this kind of like little resurgence in the dollar. After that was after the payrolls number that we've just spoken about, and now it's kind of moderating again. But the trend in the dollar is quite clear. You can see that quite clearly there. So this is the euro and cable, so euro dollar and sterling dollar, and you can see the story is the same. You've got the euro strengthening against the dollar over the period, and you can see cable strengthening against the dollar over the period as well. The UK obviously facing its own set of challenges, not quite doing as well as the euro. Euro kind of outperforming against the dollar versus the British pound. But breaking above, the British pound does seem to pick up that 200-day moving average as a trading level. So it was picking it up. So it is picking it up there. Didn't do circles for you, but it has broken, and now it's come for a retest. Short-term trade. I think I might go long pounds against the dollar. That could be a short-term trade for guys looking for that kind of thing. Now we look at the rand versus the pound and euro as well, and you can see that this trading channel that we've been looking at this chart every meeting for a long time. You can see we're right up at the top of the channel here. Wouldn't be buying pounds with your rand at the moment. If anything, I'd be doing the opposite. I'd probably be taking pounds and bringing them back into rand. Obviously, we've already mentioned the key risk event here, which is the State of the Nation address. We need to address the electricity crisis. Crime is on the rise. Our infrastructure is failing. they're going to talk about social grants and into a shrinking tax base. Soon we're not going to be able to pay for them. It's, yeah, there's trouble. Currency markets, Euro ZAR, exactly the same picture. You've got this kind of like rising trend where the euro has been strengthening against the rand, or the rand has been falling against the euro. We're right up at the top there. Now, it's, you know, again, I've put an RSI on there, which is just an oscillator, kind of says that we're in very overbought territory. If you're looking to take currency out, I'd be waiting at this stage. I wouldn't be taking it out. You have our, traditionally, we have our strong period over December. It did get below 17. It was where we were trying to push currency out. It's now weakened. I would probably just sit tight, see if we get a bit of volatility and fluctuations, and see if you can get it a bit lower down. Obviously, concerns around the Eurozone earnings. They've been very mixed this earnings season. Inflation, it's still a concern. Let's see what happens to Eurozone inflation. And there is the potential of the Ukraine war escalating. So European stocks are cheap, but they're also cheap for a reason. So one other thing that I normally just mention to everyone is, you know, when you're looking, so if we're deploying into assets overseas, okay, the rate that you get out at is important. If you want to go and buy, you know, an S&P 500 tracker, or you want to go and invest in one of our offshore portfolios, of course you want to get out at a great rate. No one wants to go and take money out at 19, invest it in a portfolio, and the portfolio does what it does. And then when you kind of convert back, you go, I put R1 million into that portfolio, and you know, like, and in rand terms, you know, the currency hasn't given you that little boost that you were hoping for. So that is something that you should be cognizant on. We all want to get a good rate. Currently, my target rate is between 16.80 and 17.10. I think we'll get back there, and I think that's the time that you need to put your foot on the accelerator, get the cash out. But you've got to balance the opportunity against the exit. And I talked about this in the last meeting as well. You can see that the risk on risk off dichotomy exists. So what happens is, when equity markets start to rally, the rand starts to strengthen. When equity markets fall and you go into like a very risky world, then the dollar does well. So the rand dollar goes the other way. So what happens is, when the currency is poor, you generally have equity markets that are low, and when, you know, and vice versa. It's actually that relationship isn't really holding up at the moment, just because we've got a much weaker currency and we have rising equity markets internationally. It doesn't normally happen like that, but you can see, and that's why we've got this. So essentially, like, the top chart is just the rand dollar versus the S&P 500. So it's just showing you the kind of the volatility and kind of like it'll actually be a correlation or a negative correlation. But yeah, I thought the easy way to kind of explain this to you guys is if you go, or if you want to go and check whether now is a good time, if you've got a rand balance that you're thinking of investing overseas, the easiest way to determine where, you know, based on a chart, whether, you know, you're at the top or the bottom of a range, just go and look at something like the Signia US 500 or the Signia US or the SIG 500, which are essentially rand priced S&P 500 contracts. So this will go up when the rand weakens, or this will go up when the S&P 500 rises. So what happens is, you know, when the S&P 500 is going up and the rand is strengthening, you know, those are two forces acting in opposite directions. But this, if you just go and look at this ETF pricing, you'll actually be able to tell perfectly which force is stronger and where it is. So the optimum place to actually exit last year, the best time to say, even though it wasn't the best time in terms of the currency, the best time to get money out and immediately invested in offshore markets was actually June last year. You can see what's happened to the rand price of US equities. And this is kind of like, I don't want to get too confusing, but it's the same as the gold example I gave you earlier. If you look at the rand price of the S&P 500, the rand price of US equities, now is probably not the time to be investing in US equities because of the weak currency. That weaker currency has shoved up the rand value of US equities. So anyone in US equities is killing it. I mean, anyone that went into our portfolios is going, woohoo, especially if you convert that back to rand, you're going to be like, wow, this thing is amazing. Like, we're doing so well. But it's because the currency is weakened and the S&P 500 has gone up. Now, how high is that going to go? Are we going to go and retest new highs? Maybe. We're not sure where it's going to go. But yeah, maybe a little, you know, when you get a straight line like that, the saying in markets is nothing goes up and down in a straight line. So maybe just relax a little bit and look for your entry as you look to deploy new cash. So let's go through the portfolio review quickly. So you can see I've got a TV show at 6:30. So we have to end a little bit earlier, but let's do the portfolio review quickly. So global managed portfolio, this is the portfolio I run. It's done exactly what it says on the tin. It's a high risk blue chip equity portfolio overseas. We go and buy the best quality companies that we think are out there, and we've really built the whole portfolio. There's the investor. So it's sorry, just on the minimum, take $50,000 minimum. It's done as a segregated portfolio for clients. We charge a 1% management fee for it. And essentially what happens is in that investment portfolio, the philosophy is we use a quantitative screening methodology, then we go and buy kind of high quality stocks. We love AI as a theme. I mean, I've got, our AI plays are, we have Google, Microsoft, NVIDIA in the portfolio, all of which will do very, very well under the AI I believe anyway, will do well if AI does well. So got kind of that tech component, but we don't forget all the other important things as well. We have Johnson & Johnson, we have Pfizer, we have United Health, we have Lockheed Martin, which is a defense contractor. And all of that has helped to stabilize the portfolio in a very difficult year. It's still equity, so if equity markets fall, it's going to fall, but it's really like, there's not 1 second last year that I thought one of the companies that we owned could ever go bankrupt. It's not the kind of, we're investing in big blue chip mega cap companies for you. And our goal is long-term growth. And why do we do this? It's because most people that are looking at investing overseas, South Africans anyway, which is primarily our client base, although we are getting a lot of new European clients, which I'm very excited about because they seem very impressed with our service. And it just means that I know Rancis is competing at an international level, which makes me really excited. But most of our clients are South African. And we do have a lot of international trusts and that we manage as well on behalf of families. But the goal is usually, once you've externalized funds, these are normally nest egg portfolios. It's the kind of portfolio that if you're worried about what's happening in South Africa, but you've still got a job here, you're working hard, you've got a business here, and things are actually okay for you. You can deal with the load shedding. You love your country, you want to stay here. Like I said, I just don't think you should invest everything that you have here as a private client. So we built this portfolio as a nest egg portfolio that if things really get bad, you've got this offshore kind of safety net, if you want to put it that way. And what does that mean? That's generally money that you're not really going to touch. We externalize it properly so it never has to come back to South Africa. And it just sits there and grows and grows and grows. And what do we want to do that? That's long-term growth. That means it should be in equities. It shouldn't really be in kind of like your medium risk, kind of shorter duration. Risk and time is often correlated. So we'd usually say, short term up to 2 years, you're probably looking at a mix of money market products and short duration bonds. Whereas, kind of your medium term, you're looking at structures, bonds, maybe a bit of property depending, but you're kind of building a medium risk bucket. This is your long-term bucket. This is 5 years plus, and it should be in equity markets, and it should be in the best companies in the world. That's what this portfolio does. So what's happened is that's your kind of monthly performance in and out. You can see we had 2 months of outperformance, very, very volatile. You can see our volatility is picked up in this chart, where we had small volatility. We then went through obviously COVID, huge bounces, and the gray line is the benchmark, the red line is our portfolio, and we basically compete month on month with it. It's totally the wrong way of looking at an equity portfolio because it's not being traded month to month. This is kind of like building it up over long term, but we kind of monitor it for you all the time because we kind of need to know if there's like, a systemic underperformance for whatever reason, and then we can adjust. So there's the performance since inception. We've run this portfolio for it's over 5 years now. It's a lot over 5 years, just I'm getting old. But inception, our benchmark, which is the MSCI World, has done 66%. We've done 85%. Over 5 years, it did 25.8%. We did 38%. 3 years it did 18, we did 19. Last year we underperformed by about 1%. We're a little bit behind over 1 year. We're now, we were down 9%. It was down 8.75. That's not point to point. That's now from February to February. Year to date, we're a little bit behind again this year, but yeah, like I said, very, very comfortable with the portfolio is doing exactly what it should. What it says on the tin is what it's doing, and that makes me happy. Even though last year was a rough year for equity investors, there was no systemic issues in the portfolio. Never had one sleepless night about the portfolio. Love it. Top 5 holdings at the moment. These are Alphabet, BlackRock, JP Morgan, and Starbucks. That's kind of the larger portion of the portfolio. You can see this is the overall, so this is just system generated, and you can see our performance since so we started this June 2016. First year, second half of the year, we did 2.2%, then we did 21.8%. Difficult year, the year afterwards, we actually outperformed by about 5% in that down market, ended 3.6% negative. I think the S&P 500 was down 8% that year. Came back strong, 29% performance the year after, 18.3%, 19.9%, and last year we were down around 20%, up 5.4% currently. So it's an equity portfolio. It's going to do what it says on the tin. It's just a big blue chip equity portfolio. And yeah, biggest gainer has been Nvidia and Alphabet over the last month. That's just in absolute terms based on our weightings. Biggest losers over the last month, Pfizer, United Health, and Amgen, the stocks that we are re-entering at the moment for clients, because this is a nice buying opportunity. Remember, the beauty of this is it's not a unit trust, it's a managed portfolio. So we can be very granular on when we deploy you. So if a stock is looking super expensive, it's not like a unit trust where you automatically get the whole basket of shares. We can say, no, man, we like that stock. It's just a bit expensive on a short-term view. We'll wait for it to come down and deploy into it. So that's exactly how it works. Right now, what we're buying into is the defensive stocks that have come down a little bit, and we're kind of sitting tight on the existing exposure on Nvidia and Google. We wouldn't be deploying that at this stage. Maybe wait for that little trend line to return. But should you be invested? Should you buy into the January rally? On a long-term basis, over 5 years, I think you're getting excellent deployment opportunity here. For me, we're in a little bit of a sweet spot in markets where we're kind of sure that it's going to go up over the next 3 to 5 years. I think you're getting a very good entry point, and all you're trying to do now is get the best possible kind of short-term entry into it. But do I think that we're going to have another dip? Hey, we might. Quite possible that we go down and we make new lows. Like, I don't know what's going to happen in the short term, but I know if we do make new lows, I'm not worried about one of our companies going bankrupt. I'm totally confident in the strategy, and I'm happy that it will continue to perform well. Thank you, everyone. Okay, so let me just finish up here. Okay, so also, obviously, we've got a whole lot of interesting voices. So I've only dealt with the managed portfolio, but we've got some really cool products coming up. From structures, we were pricing a note this morning. It looks amazing. We've got obviously Anthony Clark, who like kind of our private client base, gets some of his research, or all of his research actually. Wonderful voice in the market around the small and mid cap sector on the JSE. So if that's your thing, you guys should have an account with us. Really, weekly wrap, we send that. That's Viv. Viv is one of the smartest guys I know. He mumbles a bit, but when you get down to it and you really grill him on his underlying views, Viv will say something, a throwaway comment. You'll be like, that doesn't sound right, and then you'll kind of grill him on it. And the depth of knowledge that Viv has around what he talks about, it doesn't always come across, but trust me, I sit and engage with Viv every day. I can talk to that guy for hours. Fantastic insights in that weekly wrap. Trader Connect run by Christo, short-term trade ideas going out, just giving you levels on different stocks, looking at kind of mainly based on technicals. So just looking at the top and bottom of channels and where to get in and out. And obviously, Garth McKenzie did a nice trading course with us. We're still looking to put together his Traders Corner package for our clients. He's really moving into the offshore space now, which I think is going to be a nice complement. Tech Trader is primarily local, but he's working a lot with offshore ideas, which I think is going to be a nice addition for all the self-directed clients. So yeah, excited about that. If you're interested, 3 easy steps to open an account. Go to our account page, select the account you want. We'll ask you for KYC documents. We normally have a chat to every single one of our clients before we onboard you. We just want to understand who you are, what your background is, suitability of the product. We want to make sure that you have the right idea about what you're buying, because if you know what you're buying, you understand what you're buying, then everyone is happy and you're happy, and that's what we want, a very happy client base. So, like I said, we went through a very scary year last year, and I think we had minimal. I think we didn't have one withdrawal actually. When I say withdrawal from the managed portfolio, which means that it's been sold in the right way, which is absolutely fantastic for me. Yeah, we had a couple of obviously trading accounts. They flow in and out, and I think that those guys were maybe under a little bit of pressure, just from the living side of things. But overall, I believe we sell in the right way. And that's why you're always going to get a call beforehand just to understand who you are and if the products that you are selecting for yourself are appropriate. And yeah, then we need the money. You need to fund your account, and then we can get started on whatever product you have chosen. So thank you very much for the for attending. Adrian, we've got one question on the Rand versus Aussie dollar. I will answer that question for you, but I'm going to answer it afterwards. So your email address, I think, is in there. I'll just do a little side note for you, and we can have a look at the technicals on that. And I will. It's actually a good point, because we're working quite a lot, weirdly, with Australian flow in our treasury business. So it's probably worth adding that as another currency that we look at on a monthly basis. So thank you everyone for your time, and hopefully you found that useful. If you have any suggestions, please send them through to me. You can always hit it on info@randswiss.com. That will go through to our back office, who will let me know. Please send any questions, any suggestions, anything that you want us to cover. We're really here to serve you guys, and we're here to try and make your investment journey as easy, as profitable, and as informed as possible. So thanks everyone for attending. We will see you out there in the markets.